So guys, welcome to this video, and today I want us to talk about risk management. I know we've been concentrating on the chart work, the technical analysis and many more, but again, without risk management is like you're driving a car without brakes. So today I want us to discuss risk management techniques that we are supposed to apply in our trading. So guys, follow this video to the end, watch the end. It will give you the techniques that you're supposed to apply in your trading. I know most traders, we don't share this, but sincerely speaking, we don't have a strategy that will give you more than 70% winning rates or success rate. So now there are some trades. Let's say, for example, a trade might be 98% going your way. Then the 2% chances of losing mess up with you. So these techniques will enable you to keep safe in case of the 2% chances of losing. So Don, according to you, what do you think? Do we have a strategy that gives you, let's say, 90% success rate?
I don't think so, because the market is always...
This stuff is dry, man.
Well,
anyway.
The market is always decentralized, and no one is controlling. So we can't say anyone can give 100% winning there.
Exactly.
Yeah.
So what we should understand is that there is no 100% success rate in the Forex market. There is always chances of losing in a trade. And risk management techniques will enable you not to lose much more than you can afford. So we always say you risk maximum amount of money that you can afford to lose. So now, in the risk management techniques, we're going to apply 3 techniques. Risk management techniques. Risk management techniques. We are going to apply 3 techniques. 1, risk protection. 2, risk profile. And 3, active trade management. Our director, I hope the handwriting is visible.
Yes, very visible.
All right. So these are the techniques that we're going to discuss today, one by one. One by one. Risk protection. From the word protection, it means that we are protecting ourselves against something on the trade. So whatever you're protecting ourselves against is potential loss. So as much as you have a working strategy, you are so hopeful with your trade, you so confident with the strategy as well. But again, there's that percentage of losing. So risk protection, protecting yourself against potential loss in a trade is very important. And in this case, on the risk protection, we're going to discuss, there's what we call FOMO. FOMO means fear of missing out opportunity. We also have fear of incurring major loss. So let's say, for example, in my case, I use smart money concept as my strategy. I apply it in terms of structures. So in that case, sometimes you have identified an order block price. Let's say it was a sell, then an order block price is at around this particular point. So you're waiting for this market to come up to, let's say, at the order block price. So there's what we call inducement. So most people apply fear of missing out opportunity on inducement. So this market might sell slightly, a slight sell. So this slight sell is called inducement. So you find yourself taking a trade on this because you think now the market failed to get to the order block price, to the OB price. So whatever you'll do is you're going to take a sell here. So entering the market too early, then all of a sudden the market gets back now to your order block price, then smooth sell. So in this case, you'll find that you are applying form of fear of missing out opportunity. You had a fear of missing out this, riding this sell. So I think the market could sell from that particular point, just few pips to your entry. Then all of a sudden the market gets back to your entry, pull you out, because probably taking the trade too early, you cannot put the sell where it's supposed to be placed outside the smart money zone. So that's how people lose money. Ndio hapo hivyo unasikianga msee anasema, when I enter a sell, somebody is buying.
Yeah.
When you enter a buy, somebody is selling. But having or respecting, being disciplined on the zones of interest is very, very important. Okay, at times it might fail to activate and go and go and go. So you'll count it as a missing opportunity. But again, not to chase it because by the end of the day, the market is always open 24 or 5. So if you fail to get an opportunity on Wednesday, you can still wait for another opportunity on Friday. You see? So then there's fear of incurring major loss. Fear of incurring major loss. So I believe every strategy will guide you on the entries and exits. On the exits, we are talking about exits. Might be a sell or TP. Okay. So every strategy should guide you on the sell and the TP zone. So on the same strategy, let's say a sell here, you have an order smart money zone. Okay, that is where orders lies. Then you've taken your sell at that particular point, then sell goes well. So at this particular point, this is the zone where you're going to use for your trade. For your trade to breathe. Okay, so we need the trade needs some space for breathing. So this space for breathing is the risk part. You see, the risk part. So if you're going to place your sell here, then it means that you're placing a sell inside the structure or inside the zone where the market might get to before it continues with your buyers. So you're supposed to place a sell above the zone. So sometimes you might feel like, no, my strategy, or every time I enter a trade, I only risk 10 pips. Yes, it can be 10 pips, but it is within the zone. But again, it can be more than 10 pips, but it's outside the zone. So in this case, you're going to use or to apply more than 10 pips for you, because it will put your this is a sell zone now. The right is a sell zone. So the sell, when the sell is inside here, that means that you're going to, this market is going to trigger your sell before it continues, because you're putting it at the zone that is supposed to be a space for stop loss, or for your trade to breathe. So now, that's all about fear. Another thing on the risk protection is about confidence. Confidence and greed. Some individuals, some characters cannot fit into the market. Bro, if you are greedy, never go near Forex trading, because Forex needs people who are patient for money, and patient for the knowledge to get into their nerves, because once the knowledge gets into your nerves, that is when you'll start making money. Unless you're buying signal, and buying signal without basic Forex knowledge, you'll eventually lose money because of lack of skill and techniques for risk management. So now, in this case, confidence and greed. So now, Don, are you confident in your method?
Yeah, because your confidence comes from how when you test your your strategy, when you back
testing.
When you back test it, and you find it is working, that's when your confidence comes in. Yeah.
All right. So confidence is what will make all the difference in your trading. Without confidence, it means that you're not sure of what you're doing. So it is good, and you'll only be confident if you've learned the strategy well, practice on a risk-free environment on a demo, backtest, and eventually know the success rate of your strategy. So this is what will make all the difference in your trading, because definitely you've understood the system well, you've done your practice well on a demo account. Though some people will advise you trading on a demo account is a waste of time. Never fall for that. You know the success rate. Of course, after practicing, you should be able to tell the success rate of your strategy. So if it's, let's say, 40 to 50%, still good to go, bro. So now, about greedy as well. Greed. Some characters cannot fit into the market because you are born greedy. Like you cannot. You just want to make money today. It's as if you're not living. No.
Yeah.
So
want to get into the market with full
exactly.
margin.
It's a full margin.
Margin.
Anyway, so about grading. First of all, you should not count on anything when it comes to trading forex. Never count on anything. Saying never count on anything, when you've handled your account well, everything, just stay waiting for an opportunity in the market, apply the risk management techniques that are supposed to be applied there, execute the trade, and that's all. But not get rich quick. Forex is never a get rich quick scheme. If you come here in the mentality of becoming rich, even some of us, but they have said, I've been trading forex for more than 5 years, and whatever I've achieved up to this point, somebody might question is, bro, what have you been doing for all those years? Because maybe they are seeing other people are making it in 2 years, in 3 months.
Sure.
Okay, I don't know how they did, but myself, I've been following the process. Anyway, that's how it is. So part 2,
Okay,
risk profile.
On the same, on risk protection, there are those people who might use hedging as a type of protecting their losses or their profits.
Oh, you buy at the same time you're selling same volume. That is the worst thing to do. Okay, when I was starting up, before Forex started to make sense back 2020, I think that is what I was doing. When I see the trade is going against me, I'll just remove the sell and put another trade so that I can be able to secure both end. But by the day, you're going to lose it big. You're going to lose on the sell, and you're going to lose on the buy, or lose either. So I think it's a waste of time, because to literally make you concentrate on that trade, you cannot even think of taking another trade. So to me, I can advise you not to hedge. So it is good to accept a loss and to start looking for another opportunity. So on this profile, I just want to give an example. On this profile, we're going to have 3 things. 1, strategy, success rate of your strategy. 2, risk to reward ratio. 3, maximum threshold amount or maximum percentage risk. risk per trade. You see? Success rate of your strategy, risk to reward ratio, maximum percentage risk per trade. So in this case, let me give an example in a conventional way. We have Don here, and you have director. Director, his name is? What's your name? Director.
Mwanahabari.
Anyway, let's go with that name, Mwanahabari. So Mwanahabari is a trader, an aggressive one, an aggressive trader. Then Don here is a conservative trader, a low risk trader. So they all use the success rate. Success rate is 50%. Saying 50% success rate, if they have 10 trades, then it means that they're going to take profit on 5 trades and they sell on 5 trades. All right. So now, success rate is 50%. Using the same strategy, assume you are students of Bit and Forex. You have adopted to a strategy. You have, same strategy, 50% success rate. Then on risk to reward ratio, 1:3. Okay, 1:3. Number of trades. We have the number of trades here. 10. We have said 10, right?
Yeah.
So now, maximum account risk, maximum percentage. Kobag, maximum percentage risk is we have Don, D, and we have M. So maximum percentage risk on Don, 2% per trade. Then this person risking 20%. So this guy is a conservative trader. Let me grab here. Don is a conservative trader. And on this end, Mwanahabari is an aggressive trader. Let's say in a period of 1 week, they have equal number of trades, 10 trades, right? So this person risks 2% every time he executes a trade, or 2% per trade. And this person risks 20% per trade. So if they all have 10 opportunities in that market, assume they start with losing trade, 5 losing trades. So this person risking 2%, you multiply by 5. Risking 2%, multiply by 5. How many percent? Then 5, right?
Yeah.
10. Sorry, 10. What's on? Oh, see. I think on the other side, ile tent. Yeah. So, you see? Then on this side, this person will risk 20, will multiply by 5 trades, na kuwa 100%. So this person amepoteza 10%, this person amepoteza 100%. Already in the 5 losing trades, asha lose account blown. Then on this side, lost only 10%. So it means that Don is still in the game. Mwanahabari lost the account. Exactly. So probably this guy is going to lose focus and even give up in Forex. But this person only risks 10%. So now is the time to take 5 winning trade. time to take 5 winning trades. So in this case, he was risking only 2%, and risk to reward ratio is 1:3. So it means on the winning side, in every trade, he was targeting 6%, right?
Yeah.
So 6 you multiply by 5. This is 30%. So when you minus 30%, minus 10% lost, atakuwa na net profit of
20%.
Net profit of 20%. So Don, at the end of trading period, Don is 20% profit. At the end of trading period, Monabari is negative 100%. No account, right?
Yeah.
So now, assume these guys are trading account of $1,000 each. Don, account balance 1,000 USD. Monabari 1,000 USD. So now 20% of 1,000 USD is 20% of this.
That's
200 USD. Let's say it was a trading week. So you have closed a week with 200 USD.
Yeah.
You had 5 losses, right?
Yeah.
And you had 5 successful trades. So this guy had the same trade, but he is negative 1,000 USD account block because of maximum threshold amount that he was risking per trade. You see? So in a month time, this guy will make 800 USD, and this guy will have even given up. So these are the kind of people who say Forex is a scam. You see? So this is a risk profile that you're supposed to adapt. One, you've said
risk protection.
Risk profile that you're supposed to adapt. Risk profile that you're supposed to adapt is risk to reward ratio.
Yeah.
At least 1:3 will make you profitable. Success rate should be, let's say, 40 even to 50%. You don't need 100% if you have a good risk to reward ratio. Maximum account balance, maximum percentage of your account that you are risking per trade matters a lot. Do not risk 50% and you are not sure of your success rate is not 100%. So that is what will keep you in the market. Lastly, active trade management. Active trade management. Active trade management. Active trade. You'll forgive my handwriting as usual. Active trade management. So in the active trade management, I think this is a very common problem to many traders. It is said that only 90 or 95% of a trade, only 5 to 10% of traders makes money in the market. I don't know if you are in 10% or you are in the 90% who lose money in the market. But I know you understand this scenario if you're a trader. Every time you are in profit, most traders, especially those who do not have maximum confidence with their strategy, will start panic every time they see blue.
True.
And they can hold a loss for even 2 weeks. They're experiencing fucking huge swap fee from the broker, but they're still waiting, holding a trade. But on the other side, every time their trade turns blue, they'll close it prematurely, interfering with the risk to reward ratio. So active trade management is a technique that you're supposed to apply in a running trade. So once your trade has been activated, you need some techniques as well, because you might have a good trade but end up losing money with the same good opportunity that can make somebody else money.
True.
So on this, once you've worked on risk protection and risk profile, you will not have any problem with this, because one, you don't have fear in the market, you are not greedy, you are in confidence with your strategy. So now the trade has been activated. So if it goes south, you're okay losing whichever amount that you have risk. If it goes well, then you know the maximum, the minimum risk to reward ratio that you can apply in that trade. You see? So let's say, for example, trade has been activated, risking 20 pips. And here, your target is 200 pips. That is like a risk to reward ratio of 1:10. You see? So at times, this market might go to, let's say, 100 pips, then gets back to 50. So you'll find most traders will close at 50 and they head 100, not knowing that this was just a retracement, then kicks to your TP.
True.
So here is the technique. If your risk to reward ratio tells you at least 1:3, then it means that in every opportunity that can give you more than that, 1:3 should be your break even. So one, manage your active trade with a sell. Two, let me just write in full, stop loss. Two, break even. And three, take profit point. So basically, this is what will help you to manage a running trade. So guys,
I have a question on this one. Does it means that the whole risk management techniques is determined by the type of a trader you are?
Okay.
Whether a day trader,
Okay.
a scalper, or
Not really. Not really. Of course, a swing trader will go for many pips, right?
Yeah.
A scalper will choose to go for few pips, and these guys will take even 10 pips. So risk management techniques can be applied in any type of a trader, in any strategy. Yeah. Sure. So guys, it has been amazing doing this show, and behind us is Lake Oloiden, and Monabari. Tabidi umeonesha the view on that end, and the Oloiden Resort. It's located far end, a place called Kongoni. Far end, what do you call? Along Moi South Lake Road, at the end of Moi South Lake Road, is a place called Kongoni. I think the main feature here is a landmark. The main landmark ni Kongoni Police Station, I guess. Yeah, it's around there. So guys, see you in our next video. Tell them something.
Okay, make sure to subscribe, like and share, and follow us in all our social media platforms.